Welcome to today's Market Pulse. We're going to connect the dots between the big global stories and the key numbers you need to be watching. So let's start with the big paradox facing everyone right now. On the surface, things look pretty calm, right? But underneath, the risks are just immense. I mean, think about it. Equities are actually back above pre-war levels, even though oil prices are way higher. It's kind of like ignoring a huge leaking pipe in your basement just because the living room still looks tidy. Something doesn't add up. So here's how we're going to break this down. First, we'll look at that geopolitical tension versus the calm in the market. Then we'll zoom in on how that's hitting India. After that, we're going full tactical. We'll dive into the crucial levels for major currencies and Indian markets. And finally, we'll get you ready for the data storm that's about to hit this week. Okay, let's get right into it. We've got this so-called ceasefire between the US and Iran that's been holding for 3 weeks. Sounds good, right? Well, here's the problem. The Strait of Hormuz is still blocked. That means the economic damage is basically still on autoplay. You know, this quote just nails it. It really is a stalemate. Iran's basically saying, you lift the blockade, then we can talk. And the US is saying, no, let's talk first, then we'll think about the blockade. What you end up with is this blockade of a blockade. Both sides are just using energy flows as leverage, and frankly, it's getting them absolutely nowhere. And this slide, this really gets to the heart of the problem. The asymmetry is just glaring. For the US, this whole thing is a policy headache. It's about how inflation looks. But for Iran, it's existential. It's about their economic survival. And when you have an imbalance that stark, it almost never, ever resolves quietly. All right, so let's track how this geopolitical pressure is rippling outwards. We're going to look specifically at emerging markets like India, which just got a very sharp reminder of how much it depends on imported oil. So with Brent's crude just hanging out above $105 a barrel and even trying for 108, the impact on India's economy was, well, immediate. The market reacted like a trader who suddenly realizes their leverage just cut both ways. It was fast and it was sharp. And we saw it across the board, just broad-based selling in Indian equities. The Nifty slipped below that key 24,000 mark, and the IT sector really took it on the chin. The Rupee also felt the heat, caught between rising oil prices and just shaky global sentiment. India's macro picture is holding up, but boy, it is a precarious balancing act. All right, time to get tactical. Let's dig into the key levels for the major currency pairs. This is where the overnight action really starts to tell a story. First up, the dollar index, the DXY. What you're seeing here is just a clear lack of strength. It retreated as some of that diplomatic hope in West Asia brought a bit of risk appetite back to the market. It tried to test that resistance at 99.00, but it found a ton of sellers. With a pretty light day-to-day before a huge week for central banks, the tactical view here stays the same. You sell the rallies. Now the euro, it got a nice rebound on some of that diplomatic chatter, but it is still glued to the daily moves in crude oil. And the fundamentals, they're really lagging behind. Just look at the ECB. They just slashed their 2026 GDP forecast to a measly 0.9% because of this commodity shock. Still, the structure of the chart suggests buying on dips, with that key support down at 1.1656. Sterling found a nice floor at 1.3450 and bounced as that risk sentiment improved. But man, it's caught in a classic tug of war. On one side, you've got these surging 10-year gilt yields at 4.95%, which is giving it some support. But on the other side, you have this really bleak stagflationary outlook just weighing it down. So for now, it's still a buy on dips situation. The yen is really struggling to find a direction, and you can see why. The Bank of Japan is trying this super slow motion exit from yield curve control, all while 10-year JGB yields are creeping up towards 2.50%. I mean, it is an incredibly delicate operation. That key resistance at 159.77 has held up really well, but honestly, this is a pair to watch from the sidelines. For us, it's a no-trade zone. Okay, let's bring our focus back to India. We're going to look at the critical levels for the Rupee and the Nifty index, especially after yesterday's sell-off. So the Rupee weakened to 94.2475. No surprise there. It was all about worries over that fragile ceasefire and what it means for oil. What's interesting, though, is that after Indian markets closed, the dollar actually gave back some of those gains. The chart structure still says buy on dips, and we're keeping a close eye on that support level at 94.06. Now for Indian equities. Here's the most crucial point. Yeah, the Nifty fell sharply, but, and this is a big but, it found support right at that critical pivot point around 23,900. The level to watch now, the one that's absolutely key, is 23,876. A firm break below that, and you could see the door open to a lot more selling. But until then, the tactical view is still to buy these dips. All right, so looking ahead, this fragile geopolitical calm, it's about to run headfirst into a massive wave of central bank activity and some high-impact data. It could get bumpy. And what's really wild is just the sheer concentration of event risk this week. You've got the Fed, the ECB, the Bank of Japan, and the RBI all set to make policy decisions. Whatever they signal could either pour fuel on the fire or completely cancel out the current geopolitical story. It's going to make for a potentially very volatile week. And that leaves us with one final thought. Maybe the biggest risk here isn't that investors are ignorant. It's about timing. Everyone knows things can escalate. They're just betting it won't happen yet. But here's the thing. Geopolitics doesn't care about your market positioning, which really brings us to the real question. Is this calm we're seeing in the market just dangerous complacency? And could that be the biggest headline risk of them all?